Good day, everyone. On behalf of Farm Equipment Magazine, I'm Managing Editor Christine Book. Welcome to our latest webinar in conjunction with the North American Equipment Dealers Association. Today's presenters are Kurt Kloeppel, CFO of NADA and President of Equipment Dealer Consulting, and Trent Hummel, a former dealer executive and a Dealer Institute instructor. They're going to be digging into the results of the latest cost of doing business study. Before we get started with the presentation, I've got a few quick housekeeping items to cover. On your screen, there's a control panel with Q&A icon. You're welcome to submit questions here at any time during the presentation. Time permitting, we'll look to answer as many questions as possible following the presentation. The webinar is being recorded and will be shared with everyone who is registered for the event in case you want to rewatch it later. And I believe we're ready to get started. Thanks again for joining us.
All right, thanks, Christine, and good morning, everybody. Just a few things I'd like to mention is that like to say thank you to Fusible, which is part of Iron Solutions, for sponsoring the cost of doing business study. And also a big shout out to Farm Equipment Webinar for having me and Trent to go over the 23 results, the 2024 study. And we've been doing the cost of doing business study since 2005. First of May, we start requesting dealerships for financial information, and then dealerships have a few months. We usually go through the end of August for submission, and then we prepare the data and summarize it. And there's a few things that we have changed on this. And the participating associations, of course, NADA, Northeast Equipment Dealers Association, which is in the pink, and then Deep Southern, which is in the light blue. So if you want to order the Northeast region only or the Deep South region, please contact those regional associations and they will send those copies of the CODB study to the members, okay? And then any other NADA member that wants the U.S. North American study can call NADA, and then also Canada members of NADA can get the Canadian study sent to them. And also if they want the US study and vice versa, we'll send them if you participated. And they are always up for purchase too. So just contact NADA or the two regional associations to get your study. And we'll be sending them out, I think today or tomorrow, to the participating dealerships that have participated in this current study. Cost of doing business value. It's good for tax regulations, as you guys know, and I've said this before, back in 2015, 2016, it was very instrumental in getting the floor plan interest deduction as part of the tax regulations, which is a big benefit for farm equipment. It allows you to have 100% floor plan interest deduction on your tax return, which is valuable, especially for 24 coming up, and part of 23, we saw interest rates increase, and of course, interest expense, floor plan interest increase too. And then also inventory levels have increased, new inventory levels in 23 and also in 24. So that's a big key deduction for farm equipment dealers that we were able to enact in the 2015-2016 Tax Act. It also establishes industry-specific targets and benchmarks. It's great for dealerships merging and people acquiring dealerships and for buy-sell agreements. It's good for estate planning because it's a study for just farm equipment, ag dealerships, so it's industry specific. So it goes good when you're trying to defend the value of a farm equipment dealership if you're ever contested by the IRS. Data used in developing in the CODB is used for DI, and Trent uses it quite a bit in his presentations, and you'll hear more about it in this presentation. We have 6 CODB reports this year. First one is OPE Pacific. Now, outdoor power equipment dealers are also included in the North American averages, of course. And in the volume category, most of them are under 50 million in the volume category. Then we have data on sales volume categories, and we'll talk a little bit about how that has changed. We have the North American averages, which is Canada and US dealerships. Then we broke it down for Canada only in Canadian dollars. And then we have a US study, just US dealers. And then the two regional studies, Northeast region and the Deep Southern region. So quite a bit of data in this year's study. In past years, we did less than 50 million for volume categories, 50 to 150, 150 to 350. And this year, we changed it up quite a bit. Still less than 50 million, 50 to 200, 200 to 600 million, and then over 600 million. We think these bracket volume categories suit the business environment going forward. We're seeing a lot more expansions and acquisitions and mergers. So the dealerships are getting bigger. So, and it's possible in next year's study or for 25 that we will add over 1 billion category. It's a good possibility. And I'd like to mention that when you get to report, there's a narrative at the very beginning where I talk about what happened in 2023 as far as ratios and inventory and things of that nature. And that's based on North America averages. And also I made some comments on different volumes. Just I want to highlight that that's all US dollars. So if you get a Canadian report also for just Canada, that narrative is the same as what's in the North American US study. So if you're trying to compare the Canadian number, Canada report, because the Canadian numbers are actually in Canadian dollars. But if you try to compare my narrative to those numbers, they're in US dollars. So I just want to point that out for clarity. But when you're looking at Canada's report and your Canadian dealer and Canadian dollars, then you can match them up all the time. So that's one difference that we did last year. We didn't do it in Canadian dollars for Canada. And I think
I will say, Kurt, that is one of the nicest things that of all the years I've looked at the study, having the Canadian report compared to the North American report, but it's all in Canadian dollars for the Canadians, and the US report compared to the North American report, all in US dollars, was very, very handy. I mean, it made clarity all over on that report for me.
Good. I just wanted to point out that the narrative was still in US dollars, and
right.
And maybe next year we'll probably try to convert that narrative. I mean, the narrative is 3 or 4 pages long with different deals. So we just didn't have the time to change that narrative into Canadian dollars.
Yeah.
And then the other big change that we used to do by location, and now the averages are per entity. So if you're an entity that's doing $400 million in volume, and you look at the $200 to $600 million range, then that's average. That's what you compare your entity to that average, because that's what it is. That's what the entity is. It's per entity instead of location. So I think that makes a lot more sense too, and better comparison than by location. Don't you, Trent?
Yeah, that helped a bunch when I was looking at it too. That's a new way of doing it, and it's a welcome improvement, because then I can look at these and I can see the 200 to 600 million. You were always breaking it down by store. Now you're breaking it down by company. So it's a much easier way to look at it. And I just always want to remind everybody that the 2024 report that we're going to look at right now is 2023 data, and the 2024 report is 2023 data from the dealers.
Yeah, and 23, 22 data, correct. Yeah.
Mm-hmm.
And then, as everybody knows, the mergers and acquisitions are still happening, and with the participation we had in this year's study, that average has increased over the years. Last year 7.2, it actually went down a little bit, but in 24, 23 data is 9.3. So we're still seeing a lot of mergers and acquisitions going on. And, there's quite a few dealerships that have 10 or 11 locations. There's still a lot of dealerships that have 2 or 3 locations too, or even one location. So, and then if you look at over 600 million, that's, you're looking at 20 plus or more locations in that category. So looking at the revenues, we'll start getting into the numbers. And when you guys get these reports, there's like 36 or 37 pages that you can go through. And so you should be able to compare your dealership to what has happened in the industry for 23 pretty easy. So just remember that 24 is for 23 and 23 is for 22 and vice versa.
But I look back the 2020 numbers on this slide here to the 2024, and I look at the increases, everything, our dollars are way up. And then I look at the percent here from 23, that the whole goods are 8.1 and parts is 5.9 and service is 2.6. And I'm wondering, why didn't it jump the same amount as parts? And I'm somewhat suspicious that it's because when we have our discussion in dealerships about raising our labor rate, we always say, well, what will the customer think? So my guess is we didn't raise the labor rate to the same degree as an inflation raised our whole goods prices and our parts prices. And it's just an emotional thing at dealerships that we always say, can we raise our labor rate that much? What will the customer think? We never say that on whole goods, and we never say that on parts. We're not nearly as concerned on whole goods and parts when those prices go up because we're working off an invoice from the manufacturer for parts or whole goods. But with service, every time I go into a dealership and I say we need to raise the labor rate, the first thing that somebody says is, well, what would the customer think? And we don't say that about parts or whole goods. So my guess is the reason why this is only at 2.6%, and I highlight it in red, is because we didn't up our labor rates to the same degree as what inflation upped our parts and our whole goods prices.
Yeah, and I'd just like to point out that these are North American averages too. So that's everybody, every volume size, Canada and United States that we're looking at currently in this chart. Then we look at new and used ratios. I mean, they're about the same deal. I mean, looks like we've had a good increase, though, new to used in 24, 66, 34%. So one went up 1%. Of course, the other one went down, which is not. I think it's a good thing, really.
Well, it is. Well, this number really needs to be for the dealers, for the majority of the dealers that are reporting into this study. This probably needs to be 50-50 new to used sales. This is a metric that is never published anywhere. And I talk about it all the time in classes. And it's something that is specific to the dealership on what they sell. And even if you're selling combines and 4-wheel drives, maybe you don't take 1-year-olds. You will only take 2, 3, or 4-year-old trades as your first trade. So your number will be different than the guy that takes 1-year-olds. The guy that's taken a lot of 1-year-old trades, this number needs to be 50-50, 50% new, 50% used. So if you're doing 10 million in new, you better be doing 10 million used. If you're not, quite likely your used is going to start backing up on you. You're not selling enough used to keep up to the new sales. Now I'm working with a dealer right now, and he's a hay and forage dealer. And if we're 60, we got a 66 or 65, 35%. That's our goal. And that's keeping us right in check. They don't have any used. They got about 8 pieces of used because they're right on this mark, and every used piece is clearing out of there. So that's a good balance for them. But for the most of the people that are reporting in this study, if you're doing large ag, you better be 60-40, and you might need to be even 50-50. I just want to point that out, that this should be looked at all the time, what your percentage is new to used.
Well, and I agree, because that, it keeps your used inventory level at a nice, comfortable level too, if it's 50-50. And then also, I think maybe in 24, if looking at actual 24 data from what I've seen and heard about used equipment, that, maybe that percentage will actually increase in 2024 business this coming year, which would be in the 25 study. I mean, the closest we came was back in 21 with 37% with used equipment. So, All right, parts and whole goods inventory, inventory targets at least greater than 3 times. You look at the very left-hand side, asset turnover, same deal, greater than 3 times. The North American average was 2.5 for asset turn. And then for inventory, you're looking at 2.8 for the North American average. And then you can see it by volume. And the only one that was greater than 3 times was over 600 million in sales. 2 to 600 was pretty close, 2.8. But then the others seem decreased quite a bit from the year before, Trent.
Yeah,
Even 200 to 600 decreased too, from 4.6 to 2.8.
Yeah, there's quite a decrease. I just want to explain the asset turnover, guys, is all your assets, even your fixed assets. The inventory turn on this one, on the bigger chart here, is just parts and whole goods. We don't separate out parts and whole goods for inventory turnover. So we have to combine them together for the study. But what somewhat bothers me is 23, 22, 21, those years we had great big sales, and the best we could ever get is 4.6 turns on this 200 to 600 million. Most of it's still hovering around 3. And I know we got an inventory target over there of greater than 3. It should be more like 3.5 or 4, because most of the inventory is your whole goods inventory. And so this is telling me that we didn't do as well at cleaning out some of the older, new and used inventory in our yards during those great years, because our turns were kind of being pinched in that 3 under 4, closer to 3 for most of those great years. And I was really hoping that our turns would have improved maybe up to 4 and 5 even, but we sure didn't get there where like I was hoping. We still need to start managing that inventory that's aging, because that aging is the number one. Cleaning up your aging is the number one thing you can do to help your turns.
Well, you think, Trent, like in 2022, we had some new inventory issues, because of COVID and things of that nature, and kind of carried over into 23. Do you think, because most of the time new equipment arriving on the dealer's lots in 23 was already sold, so that turn was pretty quick. Do you think that? And then now in 23 year for 24 study, we got new inventory of more of an abundance, and yet it's not turning. I know that's not the complete answer, but that's part of it, because most of it was already sold before it hit the lots in 23.
Well, in 23 study, so that was the 22 business year. Right. Yeah, most of those orders were pre-sold. So they arrived and they were settled within 30 days. And the trades were sold. We had such activity. The trades were all sold. That's why I'm just a little disappointed to see these turns only at 3. They should have been at 6 and 7. I mean, we should have been logging that stuff really fast. Those numbers should have been high. And I know we were doing the pre-sales, and I know we were selling trades like crazy. But the reason this number held down low at 3, you could say 3 turns, is because we still had some aging equipment in our yard that we weren't dealing with, new or used.
Yep. And then interest expense, not really a big surprise because of the interest rate going up from the 24 study compared to the 23 study. And got any comments on that, Trent?
Well, on this slide here, guys, I want everybody to know that there is 2 lines of interest in the cost of doing business study. One is total floor plan interest, and the other is other interest. I've combined both those numbers to give you the 137,000 or 66,000. So when you get that study, you can actually compare if you just want to look at floor plan or just look at other expenses. So I just wanted you to know that I've combined both expense lines into this number, because I think that sometimes some dealers, when they report, some of their equipment interest that maybe is at the bank on their line of credit is actually getting reported in other interest line when they report it to the cost of doing business study. So that's why I combined them both. But yeah, we're well under 10%. And now it's creeping up, and we got to deal with some headaches in our yard. That's all.
Yeah, and I mean, you can see interest increasing on the larger volume, which you'll see if you look at the interest expense by volume category, and some of that other interest is because of expansion and things of that nature. But you're right. I think a lot of the interest is even floor plan interest gets bulked into other interest expense. So then looking at whole goods inventories, breakdown between new, used, and then total new to used. I'll let you comment on this. You got some items highlighted in red, of course.
Well, if you look at the dollars in 23 to 24, you've grown, what is it? 3.5, 3.6 million up to 5 in new. And I'm not telling anything anybody doesn't know that we have more new on the ground than we ever want. And we got an increase in used equipment that we don't want. And we don't often look at this. Most dealerships don't look at this, but this is a percent of your new and used whole goods. 60%. I mean, we all feel really good when it's down at that 55, 56, 57%, but we're at 65% of our total assets are new and used whole goods, which is too high. It's too high. And we know it's too high because it doesn't feel good right now. We know we've got too much inventory, but this is just a way to measure that. And another way to measure how much inventory we have as to what we really want. That's all I wanted to put on this slide is it's just something I use quite often that most people don't look at. And when I go to the next slide, now this is a percent of same data, but it's a percent of our current assets, not just our total assets. So when I look at this year, 2024, we got 74% of our current assets are new and used whole goods, and 12.5% is our parts. Well, that's 86.5 percentage points tied up in just parts, or of our assets tied up in parts and new and used equipment. That leaves only 13.5 percentage points for cash and accounts receivable and contracts in transit, all the other items that make up current assets. It doesn't leave much room for the other items, which we know this is cash eating business. We want more of our percentage of current assets in the form of cash than we want it in machinery and parts. And it just shows we've got way too much in machinery and parts.
Yeah, and it kind of grew quite a bit, 6% and from 23 to 24 for new equipment, which makes sense because, again, new equipment was more readily available and sent to dealerships. So you can expect some of that increase, but then you also had a 2% increase in used equipment. So, and then actually parts inventory on the opposite hand that are quicker moving actually decreased.
Well, and I think it decreased because it's not any less money in dollars. If you can see the dollars there. It's just that the whole goods are taking up so much of those current assets that a bigger dollar is even a smaller percentage in parts.
Yep.
Oh, I went the wrong way. Sorry. Here we are. Equity.
All right. Dealership equity. And this one is breaking down between the volume categories, and the average dealer, 36.3% for this current year study, less than 50 million, 32.4, 50 to 200 million. They hit the highest mark, 42.8, and then 2 to 600, 36.3, and then 32.4. And as you can see, most of them decreased significantly or a little bit, except for the 50 to 200 million category.
Yeah, and Kurt and I talked about this a few days ago, everybody. In 2019, when we did this study, I really hammered on the 50 to 150 million because their numbers were really poor. And I even, after the webinar, I even got phone calls from some dealers in that category and said, you were a little rough on us. I'm in that, dealers were complaining, but that 50 to 200 million or 50 to 150, they've really pulled up their socks. Now, you could almost say we have a little too much equity in some of these stores. Possibly, based on looking at some of this, what our equity target is.
Yeah, I would agree. I think most dealerships are pretty comfortable with the 32 to 35% equity range. So, you're getting up to, the 42%, and then it becomes a debate, or you're leaving too much in the business, correct? So yeah. There's a fine line, yeah. And then you look at debt to equity, which is another big key in how your business cycle is operating, how your whole business is operating. So 3.3 or less, as you can see, we're well below the 3.3, which is good. North American average 1.8, US 1.9. And Canada's even less, 1.4, just from the Canadian dealerships.
So in saying this, Kurt, we have this much equity in the business. A lot of these businesses could take some cash out. We don't need to have this much cash in the business. Unfortunately, the equity we have is probably not in the form of cash. It's in the form of paid inventory. So there isn't cash to take out. And I'm probably getting phone calls this afternoon and people are going to say, what are you, crazy in the head? You want us to borrow more, take money out of the business? We don't have enough to cash flow ourselves right now anyways. I know I'm going to get those phone calls this afternoon.
Well, but the thing is, your point is that you're correct. I mean, most of it is tied up and paid for inventory. So until you move that inventory, like you said before, and get that percentage up to 50-50, then that creates cash. Correct?
Yep.
So then you got debt to asset ratio, which is leverage ratio. Target is 80% or less. North American average 63.7. Was 60.5 a year ago, and then 65.5 US, 58.2 in Canada. I guess maybe things are running a little leaner in Canada.
The reason I put these slides up that have US and Canada, I've got a few more of them, but it's when I've seen a big discrepancy between US and Canada. I thought I'm going to make a note on this and put it on the PowerPoint. But I don't know why that is. Debt to asset, I don't know why it's such a difference there. But I mean, if a banker is looking at these last three sides, he's going to look at the farm equipment business and say, boy, you guys are in good shape. You got lots of equity in your business. Your debt to asset ratio is low. They're going to think we're a really healthy industry.
Well, we are, right? At some point.
We are.
Yeah. All right. Whole goods margins, new 24, 6.7, used 7%. Total 6.8, and that's a little bit of a decrease from the previous year of 7.6 total. Any thoughts on that, Trent?
Well, I put this up because I show a lot of people that 2015 to 2021 off the cost of doing business study, we always average between 5 and 6%. And so I tell people everybody says, well, we're getting 10 or 12% gross margin dollars on our whole goods. Well, for some reason, the whole industry is only getting between 5 and 6%. And then we get 22, 23, and 24 here. Yeah, we've jumped a percentage point or a half a percentage point, however you want to look at it. But I'll bet you those years, 22, 23, 24, the reason we're a little bit higher in gross margin is we had enough cash flow and we were cycling those pre-ordered units and the trades right out. We were washing out of some deals that we weren't having to pull some of those old scabs of the newer used units that had been hanging around for 1 and 2, 3 years, pull them out of the back lot and sell them for what they were really worth and take our lumps and not make any gross margin, actually have negative gross margin on some of those pieces. If we had done that during 22, 23, and 24, I'll bet you dollars to donuts, we'd have been in that 5 or 6 percentage points for gross margin dollars overall on an aggregate. And maybe we'd been a little bit higher, but I think the gross margin showing here on 22, 23, 24 is a little bit false. It's too high. If we had dealt with our aged inventory, it wouldn't be as high as that. And maybe it wouldn't be into the 5 and 6 range. It might only be 6.2, 6.3, whatever it was. But I just think we didn't deal with our aging equipment like we should have.
Well, and from what you're hearing about for the 25 study, which is based on 24 results, what's your impression? I mean, I think used inventory, the margins are going to be less than the 7% that we're showing here in the 24 study. And then that way, I think that total gross margin for next year is going to be even less than 6.8 possibly.
Well, the used gross margin on the 25 study is going to be over here like 2015 and 16, 2.7, 1.6. I don't know how low it'll be. I don't know how dealers are going to shuffle their margins, if they'll keep holding margin on new and just take their lumps on used, or if they'll not take any margin on new and try to push some margin back on used. But either way, the aggregate's going to be important. And I don't think the aggregate, will it be 5%? I hope it's 5%. Will it be less? Could be. I guess we'll find out when we do the study.
Yep, I agree. Yep. Part sales, which is kind of usually, we used to call that parts and service gravy money, so to speak, right? And it increased again in dollars and increased in percent. I think, right, if I'm reading that right.
Oh, yeah. It's increased. Yeah. I like those dollars from 2019 till now. Look at the growth in dollars of part sales we're doing per location. And we've got growth every year. And we're staying in the last 3 years at 14.5, 14.9, or 15% of our total store mix is part sales. And yeah, we should be greater than 20%, but we're not. I don't worry about the mix as long as the absorption rate is high. And there's another slide on absorption further on. But so I don't get bent out of shape with dealers when I see a mix like this at 14.9% until I look at the absorption rate. And then we'll make some adjustments.
Yeah. And again, these are North American averages too. So once you get the study, you can compare it with the different volume categories.
Yep.
And then parts gross margin, again, the dollars went up and percentage, roughly the same. Loss maybe not quite at 1%.
And the industry target here years ago, guys, it used to be 30%. Now we've actually bumped it to 32 because we just need more gross margin dollars to pay the bills. And on the volume of sales, we need to get greater than 32%. And most of us obviously are doing it. So my hat's off to everybody. We're doing a good job in parts.
Yeah, I would agree. I mean, anything over 32. And in fact, I think, further on down we go, I think that's going to increase to possibly anything greater than 35%. Service sales, again, increase in dollar amounts from a year before. Service sales mix still looks fairly good. I mean, it's a lot lower than greater than 10%. Your comments on that, Trent?
Well, it's the same. But as I said in the first slide, we just didn't up our labor rates to meet the inflation increases of parts and whole goods. So I think that's why it's a 2.4% increase. But our service sales mix, I see this all the time, about 6%. I see it often, more often than I like. But again, same thing. I don't worry about it until I go to see what the absorption is. And then based on the absorption, then we'll make some decisions what we should do with the store.
Mm-hmm. And then service gross margins, target is greater than 60%. And this past year, it's 64.4, which is a pretty good margin percent.
Yeah. And I like the gross margin dollars from 2019 to now, 24. There's an extra $400,000. I mean, we're paying some bills. We're holding our margin. And it's going in the right direction, obviously, from 60% to 64. I hope we keep that number going up.
Yeah. I mean, the only other year that's greater is in 2022. And in that year was actually for 21 financial results, which is the start of COVID. And I think that's when more people had more service work done than buying new or used equipment at the same time.
And I'll just say this, guy. This is service gross margins, not labor, not your internal work or your recon and PDI, not your warranty work and not your customer labor. Most of those labor rates are 75, 80% that I'm seeing at dealerships. And then, of course, service sales includes your trucking and your sublet. I don't know what else is there. There's a half a dozen things that affect that are other service margin areas that are not customer, warranty, and internals. And those other things are what brings this down. So the actual work that our guys are doing, billing out, is in that 75 to 80% quite consistently.
Well, that's a good point to make, Trent, and I'm glad you brought that up for the viewers. Total expenses, again, North American averages for 2024, they went up to 3,194 compared to 2,908, 12.1%, still under that 12.5, but they keep creeping up just a little bit each time, and part of it's probably the interest expense creeping up because of interest rates being high. And then, as everybody knows, employee benefits and things of that nature just don't get any cheaper.
Yeah, and I look at 2019 to 2024 again, there's about $1.1 million more to run an individual store than there was just 6 years ago. And we've actually decreased the expenses of part of revenue. And I'm going into a lot of stores right now that I'm seeing this number in single digits at 9%, 9.5%. And when I can see that, I know that store's making a lot of money. So if you can keep this expense under 12, you'll see sometimes it says here under 12.5, but I've seen it under 12, under 11, whatever. But if you keep working on reducing this number, you'll be a profitable store no matter what's going on in the economy.
Exactly. If you're actually under 10%, you're really going to be a lot more profitable.
Yeah.
Wage and occupancy expenses, we just kind of talked about that earlier about the benefits, 43.4%. So that kind of justifies why that 12.1 was 12.1 in the previous screen. And then occupancy also increased. And I think on occupancy, that's just rent and real estate taxes, Trent, or did you have something else included in there?
No, occupancy for this metric measurement includes anything anything that includes an expense to be in that building. So it's water, it's power, it's taxes, it's building repair, it's everything that is tied to the building, the rent, the mortgage payment.
I think you picked up the whole dollar amount in the CODB study. It has occupancy expense then, correct? Which includes utilities and lot maintenance and things of that nature. Yeah.
Yeah. And I put this on there because I point this out to a lot of dealers that these two expenses, wages and occupancy, 50% of our gross margin dollars are these two items. So that's why they're so important to watch, because 50% of our gross margin dollars go to these two items. And now there's quite a discrepancy between the US and Canada. And I know some guys are going to slap me in the head for this, but I'm going to tell you, I see the wages higher in the US than in Canada. And most Canadians are going to say, you're not right. And I get to see dealers' financials, and I can tell the Americans are having to pay their people a lot more money than the Canadians are. When you factor in exchange and so forth, the Canadians they're getting a deal on their people, actually.
Well, I mean, this chart kind of shows that, correct? I mean, it's 35.9% compared to 43.4. I mean, you got a little bit of conversion factored in that, but still. Profit from operations, the big animal in the room, so to speak, I guess. 2024, 4.1 North American average. And then we range from 2.9 all the way up to 5%. And then that same category is hitting on target again, Trent. And it's good.
Yeah, I wanted everybody to understand this is a measurement from operations. So this is just your whole goods, your parts, and your service. The next slide, you'll see it from net income before tax, NIBT. But yeah, so this profit, this gets measured very seldom. Nobody ever talks about profit from operations. They always talk about NIBT or EBITDA, whatever you want to call it. But greater than 4%, we're doing fine. Yeah, we've had some reductions. We know what's going on in 2024 study versus the 2023. But those guys in that 50 to 200 million, they seem to be holding their own. So, but it sure is a lot better than 2019, 2020, 21.
Oh, yeah, you look at those numbers, 2.8 and 1.6, and big difference. And then net income before tax, the average in 24 was 4% compared to 5.4 in 23. Target's greater than 5. Canada, I mean, it's 6.7. 6.8, so they dipped a little bit, but not quite as much as what we did on the U.S. side.
Yeah, and I want to mention, years ago, guys, this target was 3, greater than 3. But most dealers won't tolerate 3 anymore because we have too much money invested in these business to put up with a 3% net income before tax, put up with that kind of return. We're not going to put up with it. So we have actually bumped it up to 5 because it seems like most dealers are saying, if I can get a 5%, I'm okay. Now, the big discrepancy between the US and Canada, this is another one. I don't have an answer for this, but I do know that the Canadian market always lags behind the US market when there's a correction by 6 to 8 months, 6 to 12 months. So could it possibly be next year when we look at this that the Canadians fall right in place with where the US is? It might be, but I do know there's that lag. And if you know what you're doing, you can always be watching for that lag, what's going on in the US, and you can adjust your business if you're a Canadian to say, hey, they're having a problem in the US, they're having a market correction in the US. It hasn't here yet, but it's gonna in 6 to 12 months. It's by the book every time, all the time that happens. So the Canadians have an advantage to watching the US markets to see what's going on, to see what will happen in their backyard in the next year.
Mhm. All right, the return on assets, targets greater than 6%, greater than 10%, and return on equity between less than 20 and greater than 30. Where did you put that in there, Trent?
I got that wrong. Sorry, it should be greater than 20, greater than 30. I just want to talk about these targets. You know, it used to be 6 on assets and return on equity was 20, but it seems like the market wants that a little higher. So I see it, some consultants will put 10 and 30, whichever. I mean, get between 6 and 10, get between 20 and 30, get above 10, get above 30 if you can. I'm all for it. Make as much as you can. Now, we should be making money on our investments. But we're in good position right here. We're looking good compared to what we were 6 years ago. These numbers are showing super returns.
Yeah, I would agree. I mean, 24, I mean, even at 11.8% return on assets compared to how much inventory has increased, that's still really good. And then on the flip side, you know, if you got more inventory, you're going to have more liability. So that's going to reduce equity, and return on equity is going to reduce, but still at 31.3%, really good.
Yeah, any banker looking at this is going to say this is a great industry to be in. He's going to want to put his money into it. So.
Well, that's why you're seeing more acquisitions and things of that nature, you know, in the industry.
Yeah.
The employee average in 24, and this again is all North America number averages, 23.5, 23.7, pretty much, you know, no change realistically. In fact, not much change in the last 3 years for employees per average.
And target here at the bottom, about 1 million. I put about 1 million because there is really no established target. And it wasn't only a few numbers of years ago, 10 years ago, 15 years ago, we used to talk about $750,000 per employee, but that's not enough. We can't make enough gross margin dollars to cover our expenses with doing $750,000 US per employee. We need to get about $1 million and even get a little higher gross margin on that $1 million we're doing in order to pay all our expenses and make $1 at the end of the day. And for the Canadians, it used to be 750,000 for a US and 1 million for a Canadian. And now it's 1 million for a US. And you add your exchange rate, 25, 30% for the Canadians. But we're doing good here. And there's nothing wrong with this number.
Yeah. I mean, the last 2 years, you know, they've been over the $1 million and quite a bit of growth from 23 to 24 per employee. You know, so almost 100,000, you know, per employee growth.
And then I put this in here so you had some historical data back to 2019, separating out the dealerships or the US and Canada. You can see the US guys are really hitting it out of the park. Canadians, that's not quite 30% off. The 1.1 million US is not quite 30%. The Canadians should be about 1.6, but I mean, they're making money, so who can complain? The Canadian stores are making money.
I mean, they're pretty close to being 25%, though, right?
Yeah, you're right. They're at pretty close 25.
Yeah. And then gross margin per employee. I think you added this slide too, Trent. So I'll let you comment on it.
Well, this one stuck out to me where the under 50 million per average employee is only $155,000. But it's 18.8% of their gross margin dollars. And then I go to the greater than 600 million category, and they're paying 237. So if you just looked at the dollars, you'd think, well, this is terrible. The under 50 million is paying a lot less money per man, using a lot less money of their gross margin dollars per employee than what the over 600 million guys are. And that's true in dollars, but in percentage, the over 600 million are not using nearly the percentage of their gross margin dollars that are coming in their stores to pay that higher average. This one stuck out. I just wanted to point that out. And it's a declining number. If you look at the four categories there, it goes 18.8, then to 18.3, 16.2 usage of your gross margin dollars, down to 14.5. So there is some synergies to being larger complexes. There is some benefits.
Yeah, some savings on some combining expenses or some savings, right? Yep.
And this one here, the target down at the bottom is 140,000 to 200,000. Boy, this has been all over the board. In the last 5 years, I've seen this number, different consultants write different numbers down. Really, it just depends on your expense load. What are all your expenses, all your other expenses, to how much gross margin dollars you can pay per employee? Really, that's where it works out to be. So can you make money at what you're paying?
Mm-hmm. And then I think you added this screen too, didn't you?
No, this was in here, but this is just historical too, from 2022, 21, 19, to show that whatever we're doing, we're paying a lot more of our gross margin dollars. We're paying more than we were in the past. It's just to show the growth. That's all.
Right.
But we'll get in here to absorption.
All right. And then this is definitely in your wheelhouse. So I'll let you take this screen.
Well, this is another one that the discrepancies between US and Canada were so much, I thought I need to put them in two different charts. So that's what I did. I'll just talk about the target here. I've seen the target at 80% plus. I've seen the target move up to 100% plus. I don't know what the target is. I mean, everybody wants to be over 100, just like they are in automotive. Automotive's 110, 120 often. I got a few dealers hitting over 100 consistently. I got some dealers that say, if I hit 80 or 90, I'm really happy. They can make it work. Well, whichever. But I just wanted to show there's quite a difference between the US and Canada. And I don't know why this is going on, unless it's because the US market is market correction than the Canadians. And that might, I don't know what's going on with that, but definitely, are the Canadians paying less money in wages? Yes, obviously from a chart prior to this one. Does that drive their absorption rate higher when they can pay less wages? Yes. I don't know why this is such a difference here.
Yeah, but I don't know if that would justify a 79 to 68% difference for 24 just because of the cheaper wages, though. It's got to be
I don't think
reason.
so.
Yeah.
I don't think so. I agree with you. It's just not wages. There's something else there, because occupancy is pretty flat. And those are your two biggest expenses in the business, wages and occupancy. And there's got to be something else here.
What does any internal service work get involved in this absorption rate? I mean, maybe there's a difference between how US and Canada is handling that.
Oh, shouldn't be. That shouldn't affect it. No, I'd have to tear into this a little more, but I just don't have an answer right now why this is so different.
Okay. All right, that puts us pretty much to the end. And again, would like to thank Fusible for being a sponsor of the CODB study and farm equipment webinar for hosting this, and also thank the participants that are viewing this webinar today. Appreciate your participation, and appreciate the participation of all the dealers that contributed their financial statements to this important study. There's a slide on Dealer Institute, which Trent is a part of, for all the different programs that we offer the dealerships to help improve their margins, service margins, get their absorption rates up, things of that nature, inventory handling. So I think I covered a little bit, haven't I, Trent, on how this can help you.
You bet. Yeah, we're open for questions. Christine?
Thanks again, guys. Yeah, great job. We're going to get started on some questions. We did get some coming in. I had a few interesting ones. The first came in a bit ago, so if you feel you haven't addressed this yet, feel free to. He asked, is the volume bonus calculated into gross margin?
Yes.
Okay. Next question. It was mentioned that occupancy costs should be less than 10% of total store gross margin. What expenses are included in the occupancy costs?
Everything that it takes to run the building. So property taxes, all your utilities, any building repair, and your rent or your mortgage.
Right. And then I think there might be some like financials that have lot maintenance, lot upkeep, things of that nature. That's part of occupancy, for their yards and to keep the inventory presentable and clean and things of that nature. So, but basically the main numbers are rent expense, real estate taxes, and utilities.
Yes.
All right. Another one coming in. In the merger and acquisition work Kurt's team is involved with, what percentage is merging dealerships together? And what percentage is dealerships acquiring and buying out other locations?
Well, I think currently, the way the dealerships are getting bigger and bigger, I think we're seeing a lot more of mergers happen than straight acquisitions, but there's still straight acquisitions still happening because you're getting different investment companies, private wealth companies, things of that nature that are looking into the ag industry that are just doing acquisitions instead of mergers. So, before is probably, 5 years ago, it's probably 65% acquisitions and 35% mergers. And now it's probably close to 50-50.
And I'm going to ask this question, Christine, for how many outside agriculture dollars are coming into these dealerships? Like how many private equity firms that have never bought an ag dealership in their life are looking at buying dealerships? I mean, they do it in the car business all the time, but
there's been quite a few. I don't know the exact number of them, but yeah, there's been quite a few private wealth families, whatever you want to call them, private wealth investment companies that have actually purchased dealerships across the United States and Canada, mainly United States. And then we're also seeing more interest in that because I've had different people contact me that they're looking at the ag industry.
Another question just in, a follow-up question on the volume bonus. She asks, so if it is included in the whole good margin, is it credited 100% new whole goods?
I would have to get back with that person on.
Okay. And we can make sure that we connect you with her so you can get in touch.
Right, right. And also the person that actually said volume, I'm 90% sure that the volume is calculated in the gross margin, but we can get back with them on that too.
Terrific. And then last one coming in, total wages as a percent of gross margin target should be less than 40%, as tech salaries are a service cost of sale. Are tech salaries included in this calculation?
Yes, that's all wages in the store in that calculation under 40. So even though tech salaries are a cost of sale to the service department, in that calculation that was presented on the slide where it's under 40% of your total gross margin dollars, tech salaries, all of the salaries of everybody in the store are included that. So I've seen that anywhere from a low of 38 target to a midline of 40, 42 to a very high of being 44, 45, 50%. So we have a simple target. Instead of having a range, we just have a target of under 40%. But yes, it includes your tech salaries.
Terrific. All right. I think we've covered everything. That's about all we have time for today. Today's presentation and audio will be made available on Farm Equipment's website in the event you'd like to go back and review it. Watch your email and the Farm Equipment newsletter for more information. And on behalf of Kurt, Trent, the NADA team, and the Farm Equipment staff, we thank you deeply for joining us for today's webinar. There will be a short survey that pops up once you leave the webinar, so please let us know what you think. And you can always reach out to Kim or I directly with any topics that you'd like us to cover in future webinars. Thanks again, everyone. Enjoy the rest of your day.